President Biden, what is wrong with you? Why are you going and opening your yap about draining the SPR? Bitch, neither you or I can print more oil. What the fuck are you even doing? Do you want me to keep hiking into the election? Wanna see how well that turns out for you? I want you to walk twa on that thing and press the sell button, okay?
Welcome everybody to the daily recap show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500 and a very mixed day, a very red day, I guess. Very mixed data today, worse than expected data, especially on the inflation front, and that saw stocks really pull back from the highs they made yesterday. Except in infrastructure tech, this part of technology continues to power ahead, relative strength. Same too with Nvidia here today, as well as MU, Micron, Nvidia up 1.37%, Google relatively flat along with Apple, Amazon up 0.64%. And these big names really held up the market today, especially in the Nasdaq 100 and the S&P 500. They really helped the market stabilize what was a very hot inflation print. Along with those bigger names outperforming, we saw outperformance in United Health as well as energy. The S&P 500 in total fell 0.19% today, and this was on the back of a hotter than expected consumer inflation report. CPI month over month for headline and core came in at 0.2 and 0.3% respectively. The market was expecting 0.1 and 0.2%. That meant the year over year figures printed 2.4% and 3.3% for headline and core. The market was expecting 2.3% and 3.2% for those figures. Hotter than expected inflation, and while the trend is still down, yes, we did see the year over year rate decrease from 2.5% to 2.4%. This was hotter than the market's expectations. Compounding onto this, initial jobless claims soared to 258,000. This was the largest weekly print since October 2023. The move was actually higher on the back of last week's 225,000 reading, and economists pointed out that this was largely due to the Boeing and dock workers strike, as well as several hurricanes that have hit different parts of the US over the last couple of weeks. And like it affected initial jobless claims, this also affected inflation data. Now, the weak economic data we got today is why the market was very red. The S&P 500 fell 0.9%, but to be honest, it actually really held in there, all things considered. And this is mostly on the back of XLK, the technology sector, the largest sector in the S&P 500. It was virtually flat today. XLB and XLE, so materials and inflation hedges, performed really well today. And when you have stickier than expected or hotter than expected inflation data, materials, energy, and the inflation hedges are really going to work today. Gold worked, silver worked, energy worked. That's why XLE, XLB were up. XLK technology gained, and that was on the back of stuff like Google being flat, Apple being flat today, and then Nvidia gaining. Those are huge names that really move the market, and that's why the SPY was only down 0.19% today in the context of what is horrendous data. When I saw the data, I thought the S&P 500 was going to fall like 1.5% today, but very resilient market, and that's just a feature of bull markets. Stocks that underperform the SPY, we actually saw the worst performing sector was real estate because yields actually rose today on the back of that data. XLC communication services was down 0.74%. We saw industrials fall as well as discretionary staples, healthcare, financials. It was a pretty red day across the board, but given the dynamics we saw in the data, I really did think it was going to be much worse when the data was released pre-market, but stocks were very, very resilient in light of everything. Looking at market breadth, shorter term moving averages have started to trade down. You can see stocks above their 5-day and 20-day moving average today and yesterday actually fell below the 50% mark, currently sitting in the mid to high 30 range. However, longer term moving averages are still very, very constructive. So longer term market breadth still looking constructive. Anything above 50% is very, very constructive. That's exactly what you want. It's what we're seeing. However, this is how it starts. It starts at the shorter term moving averages, moves moves to the 20, and then moves to the 50-day. So what the bulls need to do is hold the 50-day moving average. We don't want to see deterioration, because if we start to see deterioration, in other words, a move below the 50% mark in the 50-day, that opens up the 100-day and then the 200-day longer term moving averages. However, long term, things looking good. Shorter term, we are seeing a little bit of weakness. And looking at the factor and size segments of the market, large cap growth was the best performing factor, gaining 0.2% here today in light of everything. Mid cap, small caps, value core, and growth all fell significantly here today, as well as large cap core and large cap value as well. So, if you really were in these big tech names, these growth names, they did well. That was really it. If you were in any other parts of the market, you did experience losses. But mid caps and small caps are sensitive to inflation and rates. And again, they held in there. I think today there was a lot of relative strength under the hood that no one was really talking about. And I'll show you what I mean on the charts. So this is the S&P 500. If we actually just zoom in here, guys, okay, we just zoom in. You see this red candle right here. This right here was the August inflation report that came in slightly hotter than expected. Look at the depth of that candle and look at today's candle after a hotter than expected inflation number. That really goes to show the relative strength in the market. The S&P 500 only down 0.21% for a day with hotter than expected inflation, worse than expected initial jobless claims to fall 0.21%. Super strong, if you ask me. A lot of relative strength under the hood there. Although yes, led by the large caps, the mega caps, the Nasdaq 100 only fell 0.13%. Now this is still a loss, guys. Still a loss on the day, don't get me wrong. And then the IWM was down 0.55%. Mid caps down 0.44 and 0.66% for the S&P 600. And then the RSP was sort of in the middle, the equal weight down 0.37%. Mixed action here in the after hours. Yields were very mixed as well. We saw the 2-year yield fall, the 10-year yield was flat, the 30-year yield did gain. Bonds very mixed as well. The dollar was largely flat after today's price action. A lot of moving parts, but the outperformers were commodities. Gold up 0.85%, silver up north of 2%, and crude gained 3.7%. If you were diversified into commodities today, you probably had some hedging impacts after today's inflation print, and I think that should help you over the next couple of days leading up into PPI tomorrow as well as into next week. So I do think having a small allocation, anywhere from 1 to 5% of your portfolio, anywhere from gold, silver, crude, should do very, very well to negate days like we did today when we get hotter than expected inflation. Just have some alpha generated in these names. Diving into the S&P 500, this is the gamma chart, and we saw the gamma flip zone move ever so slightly up from the 5700 to the 5725 level. So that is bullish. We are in positive gamma, and our target is still the 5850 level at this point. That's the core resistance, which means in positive gamma, we buy dips, sell rips to this level. In a positive gamma environment, we buy dips, sell rips to the core resistance. In a negative gamma environment where we're below the gamma flip, we sell into weakness, buy into strength, ultimately aiming for the put support where we actually do find support and then normally rally back into positive gamma. That's the game we play here on this channel. Now, the gamma flip zone, 5725 for the S&P 500, we're in positive gamma. We're also in the same situation for the Nasdaq 100, well above the gamma flip zone, but at the upper end of the core resistance. It has not moved in like a week or so. So, traders are really content on this 20,400 level. So I think we are going to see some resistance. However, if we do break above, it's going to be a violent move to the upside. But if we can't break above this level, we probably move lower in the Nasdaq 100. And you see this equal high causing us a little bit of problems here in the Nasdaq 100. Looking at the RTY, very interesting. We did get into negative gamma ever so slightly here today, but the bulls came in a very big way. Let's actually look at the 1-minute chart, the day's view. So this is where we had that inflation print, the data. And so essentially what we had was this violent move to the downside. We actually broke the gamma flip zone right here. We were in negative gamma. In negative gamma, you sell into weakness, buy into strength. Very volatile moves, right? In positive gamma, you normally do this. In negative gamma, you actually do this, right? And that's the type of price action we saw. A violent move to the upside, back into positive gamma, and then we just buy dips, sell rips, and then we slowly just made our way sort of not to the day's highs, but sort of to these highs right here, the 2190, 2200 level, I guess you could call it, in the Russell Russell 2000. I wouldn't call it constructive price action. The fact that we saw negative gamma isn't really a good thing. However, the 2180 level, this gamma flip zone, is definitely being held by the bulls. The bulls are coming in a very strong way, holding that level. However, but if we do get a close below that level, things will and can get very, very ugly very, very quickly, especially if the put support moves down. And the second we get a close above the 2180, this put support is 100% moving to lower levels, and that means lower levels will ensue for the Russell. However, if we do continue to hold this through the month of August, then Q4 becomes a tailwind, and then we probably see upside in the Russell 2000. So guys, we're at a critical zone for the Russell. It needs to hold these absolutely key levels, but we're not in such a critical level for the NASDAQ 100 as well as the S&P 500. I think things are looking largely constructive, relatively speaking, especially with the data we got today. And then looking at the equal weight, the broad market, very much the same like the NASDAQ 100 and the S&P 500. And it seems the market likes to be positioned in these larger cap, higher quality names over higher beta, especially with yields rallying in the last couple of weeks and the inflation data that we just got very recently. The market finds safety in larger names, and I think that's why they outperform and probably will continue to outperform for the rest of this week. You know the key levels in the S&P 500 and the NASDAQ 100. Guys, we are in a volatile month of the year heading into an election, so we are going to get volatility. We can get massive moves down, we can get massive dips, but you want to look at the bigger picture. Year to date, things looking very, very constructive for stocks, and that's going to continue into year end, so buy the dip. And looking at sentiment, this is the AA sentiment survey, and the latest sentiment survey shows growing optimism among traders, with the majority of the market feeling very, very bullish over the next 6 months. Guys, we're at peak euphoria right now. 49% of sentiment votes were bullish, only 20% were bearish, 30.4% were neutral. Guys, this is very, very bullish sentiment. In fact, the truth is we actually don't really go anything higher than the 50 handle. We maybe might get a 51, maybe a 51 and a half. That's really the peak of it. And we're also seeing bearish sentiment drop down. You can see in both instances, bearish sentiment as well as bullish sentiment votes are well above the historical averages. And at the end of the day, positive sentiment continues to fuel momentum, and this is extremely euphoric sentiment at new all-time highs. But if we dive even deeper into the data, historical data shows us that when the market reaches new peaks, new all-time highs during the month of October, it tends to outperform in the fourth quarter. Since 1950, when the S&P 500 has had an average gain of 1.4% in October, the subsequent fourth quarter returns tend to be very, very positive. This is in light of the fact that October in election years tend to be very, very negative. So when we have a positive October, we tend to see a positive fourth quarter there still. So a positive October doesn't necessarily correlate to a bad Q4, it just correlates to an even higher fourth quarter. And we see extremely strong hit rates. 90% of the time the fourth quarter is higher, and this compares to the market average where we see 4.3% returns in the fourth quarter, 79.7% of the time higher. While we can expect volatility in October, if we push aside that volatility and move even higher, make even more highs into this month, do expect much of the same into November, into December. And adding on to that, when the S&P 500 closes within 0.2% of an all-time high, like it did a couple of days ago, and the VIX is above 20, the average 12-month forward return tends to be very positive as well. The market is higher, 16% on average, a median return of 18% with a 90% hit rate. These are extremely good odds. 9 out of 10 times you're higher. You want to hold equities in this environment because the data points to us going higher, and all we're actually doing at the moment is just making new highs. We've had 44 new highs for 2024 so far, and the estimate is that we will continue to do so, with the 2024 estimate at 56.9. And pretty much what this data is telling us is that we do go higher, and we are clearly seeing a broadening out. This isn't isn't a thin rally. We are seeing a broad-based rally among constituents in the S&P 500. This is returns from July 11th all the way into October, pretty much the last trailing quarter of the year, and you could see that tech was the only loser in the last 3 months, contributing a negative 0.01% return to the overall 3.72% return in the S&P 500. So while tech has underperformed, it hasn't really detracted from the S&P 500, and that's why we're seeing very bullish results, with the top contributors being financials and industrials, and we're also seeing every other sector gain, which is very, very positive. We're seeing stuff like healthcare, staples, discretionary, utilities, real estate, materials, all putting up very, very solid gains in the last 3 months, a broad-based rally, and the S&P 500 has actually gone to hit multiple new all-time highs while tech wasn't really participating in this rally. And the bottom line, guys, the market is rotating, and rotation is the lifeblood of a bull market, as well as fundamentals. As long as the fundamentals are sound, stocks can continue to rally. This is 2024 and 2025 earnings per share revisions, and what we have been seeing is that revisions and earnings have come down in a significant way, but still positive, and this is normally the case. You can see the historical average sees downward revisions of anywhere from 7 to as much as 12% leading up into the relevant quarter or the relevant earnings season period. So down revisions to be expected. Right now in 2024, we are tracking well above the historical average, but below the pre-recessionary average, which is this dotted line right here, which excludes earnings revisions from COVID, the GFC, as well as the year 2000. So we're kind of tracking in the middle. 2025 revisions actually seeing slightly up to flat revisions. However, we have seen a massive pullback in both 2025 and 2024 earnings, and both will actually break it down a bit further for us here. Bank of America has lowered its 2024 earnings per share estimate from $250 per share to $243 here in 2024. And looking out to 2025, they actually expect a 13% gain on $275 of earnings per share in the S&P 500. And they say, in hindsight, while this figure may seem unrealistic, real sales growth, excluding the Magnificent Seven, is coming in at 3% for 2025. Since 2024's growth is only expected to be 0.6%, the 2025 forecast is not in fact overly optimistic because we're coming off a weaker comp. So 13% or 13 to 15% growth, if you're looking at both the strategy or the bottom-up consensus, is actually quite achievable. And guys, when earnings are growing like they are expected to grow here in 2024 and 2025, we want to hold equities because generally speaking, when earnings move higher, stocks move higher. And diving into the macro, guys, we got the latest iteration of the Fed's GDP now, their third quarter tracking estimate, and it's now sitting at 3.2%. Very robust growth. This is great. Now that we're in a cutting cycle, everything comes down to growth and how the economy is faring. And if the economy is good, if growth is robust, if we avoid a recession, stocks do very, very well in that type of environment. After the construction spending data we got last week on the 1st of October, the Fed's GDP now was sitting at 2.5%, and ever since we got the manufacturing data, which was really good, especially the services side, the labor market data, as well as wholesale and international trade, we're sitting at a 3.2% GDP tracking figure for the third quarter. Very, very robust. For the record, bottom-up consensus estimates are sitting at about 1.7%. So we are either going to blitz the analyst estimates, or we're going to see a significant deterioration in this figure on the back of weaker than expected data. And after the labor report we got last week and all of the data we're seeing right now, I just don't think that's the case, especially with rate cuts. I think we're actually going to see significantly better data because the consumer is also hanging in there. We got Costco's latest retail data. They release it every single month, a great parameter for the middle class consumer. And Costco reported sales data of 24.62 billion, up 9%, guys, year over year. USA data reported growth of 9.3% year over year. E-commerce reported 22.9% year over year. So the e-commerce segment of Costco is growing significantly. Maybe that's why it has such a huge multiple, because this part of the business, a higher margin part of the business, is actually growing a lot quicker. Comparable sales at the company level was 6.7% for the month right here. And this compares to the previous month of August, which was at 5%. So we saw year-over-year growth, sequential growth, e-commerce growth, and the US up 9.3% in the last month. Very, very strong figures here from Costco. This is exactly what you want to see. Growth is looking good. The economy is looking good. The consumer hanging in there, especially the middle class, upper middle class consumer. This isn't recessionary, guys. This bodes very well for the broad economy and stocks. And what we're also seeing is inflation. CPI printed at 2.3%. Disinflation continues, and this is Goldilocks. Continued disinflation, strong consumer, strong and robust economic growth, which is supported by overall just strong economic data, especially since the June-July period. Very, very Goldilocks data, guys. You want to hold stocks in this type of environment. I know I've said that like 4 times this video, and I will keep saying because it is the truth. Guys, tomorrow earnings, a very, very big day of earnings. We have JP Morgan and Wells Fargo. Those are the 2 you want to look at, but we also have BlackRock, BNY Mellon, Fastenal, and then from next week, earnings really kicks off. On the data front, we also have core PPI and PPI tomorrow. The month-over-month expectation is 0.1 and 0.2%. Other than that, consumer sentiment to come in at 71, and then that's the inflation data done for the week after tomorrow. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell as well as the like button, and leave a comment for the algorithm. Cheers.